Most people will work for 40 years and die with less money than they made in their final decade. Let that sit for a second. They'll spend their entire productive life trading hours for dollars. Then in their 60s, when their bodies finally give up and they have time to actually enjoy money, that's when they'll have the most of it. And they'll be too tired to use it. There's a better way. Not a faster way, a different way. It doesn't require you to start a business, pick winning stocks, or become a financial guru. In fact, it requires almost the opposite of what you think. This is how you build wealth while you sleep. Here's what nobody tells you about money. The rules are different at different scales. If you make $40,000 a year, you have one job: spend less than you earn. That's not a strategy, that's survival math. But somewhere around 6 figures of accumulated wealth, something flips. Your money starts doing work that your body can't. Not because you're suddenly smarter, but because you finally crossed the threshold where the system itself carries you forward. The wealthy don't think about money the way you do. They don't think about salary. They don't think about raises. They think about passive income flows and compounding engines. I know that sounds like jargon. It's not. It's just a different language for the same physics. You already understand compounding. You've just never called it that. If you save $100 this month and it earns 5% interest, you earn $5. Boring. But next month, you're not earning 5% on $100 anymore. You're earning it on $105. The growth grows. That's it. That's the whole thing. Most people skip over this because it feels too slow at first. And they're right. It is slow, for the first few years. The math of compounding is absurd in a way that nobody warns you about. It's not exponential because it's exciting. It's exponential because it genuinely accelerates in a way your brain isn't built to predict. But here's where it gets interesting. Almost nobody actually lets compounding happen. They interrupt it. They access the money. They panic when markets drop. They move the goalposts. The people who get rich aren't smarter than you. They're just more boring than you can imagine. Let me show you how this actually works. Say you're 30 years old. You have some money. Not a lot, maybe $10,000. You put it into something boring, an index fund. It returns 7% a year on average. That's been the historical average for stock markets over a century. Nothing fancy. In year 1, you make $700, doing nothing. By year 5, you're making about $840 a year. That extra $140 came from the money you earned previously, earning interest on itself. Still boring, but stay with me. By year 15, you're making $1,860 a year for sleeping, for existing. By year 25, when you're 55, that $10,000 has grown to $54,000. You're now earning almost $4,000 a year in passive returns. By year 35, it's $180,000, and you're making over $12,000 a year. You didn't add another dime after that initial $10,000. Most people hear this and think, okay, that's cool, but $12,000 a year is not enough. And they're right. $12,000 isn't life-changing, but you're not looking at the math right. The point isn't that one $10,000 deposit creates $12,000 a year. The point is what happens when you systematically repeat this. This is where automation enters the story. Automation is just removing the friction between earning money and investing it. It's boring, but it's essential. Here's how it works in the real world. You set up an automatic transfer on the day you get paid. Before you even see the money, it goes into an investment account. $200, $1,000, whatever you can afford. This is not heroic, but it's relentless. Most people think they need to find money to invest. They'll start next month after they've organized their finances. They'll invest when they have more discipline. These are the stories people tell themselves before they don't do the thing. Automation removes the story. It removes the decision. You set it, and it happens without you. Now here's where the multiplication starts. Let's say you're 30 years old. You make a decent income. You automate $200 a month into an index fund. That's $2,400 a year. You can afford it. You don't notice it gone. Year 1, you've contributed $2,400. With returns, you have roughly 2,600. Year 5, you've contributed 12,000. You now have 15,500. Year 10, you've contributed 24,000. You now have 35,600. Year 20, you've contributed 48,000. You now have 115,000. Year 35, you've only contributed 84,000 of your own money. The account has grown to almost $500,000. The compounding has generated $416,000 out of thin air, out of time and mathematics. By year 40, you're a millionaire. You've contributed 96,000 of your own money. The market has generated 900,000, and you've been asleep for most of it. Literally. You were sleeping when that money multiplied. This is not a get-rich-quick scheme. This is a get-rich-slowly scheme that actually works because it's slow. But here's where the script usually ends and reality begins. Most people don't do this, and the data on why is brutal. Americans accumulate less than $40,000 in retirement savings by age 65, the median, not the bad ones, the average person. That's not because they didn't understand compounding. It's because they interrupted it 17 different times. The market crashes, they panic and sell. They need the money for an emergency. They withdraw it. They get a new financial advisor who says index funds are boring. They move to crypto. They read an article about inflation and get paranoid. They move to real estate instead. They see their neighbor get rich on some stock tip. They abandon the plan. Compounding only works if you let it work, and most people have the attention span of a caffeinated squirrel. The uncomfortable truth is this: the system is designed to interrupt you constantly. Financial services make money when you move your money around, when you trade, when you switch strategies, when you panic. Every time you act, someone collects a fee. The one thing nobody profits from is your patient holding of a simple, boring index fund, so nobody is incentivized to help you do that thing. Brokers, advisors, crypto influencers, podcast hosts pitching get-rich schemes, your uncle who trades Forex on YouTube in his garage, they all have the same incentive structure. Keep you moving, keep you anxious, keep you changing strategies. The greatest wealth-building tool available to a regular person is the one thing nobody profits from, so they don't talk about it. And when they do, they make it sound exciting. Disruption, innovation, the next big thing. Meanwhile, the boring thing, the thing that actually works for regular people, sits there accomplishing compounding in the background, completely ignored. This is where automation becomes almost therapeutic in its genius. Your brain is not built for delayed gratification at scale. We evolved to notice short-term threats and grab immediate rewards. A rustle in the grass meant a predator. Not reacting meant dying. But wealth compounds over decades. Your brain has no evolutionary hardware to make that feel urgent or real. Automation solves this by making the thing you should do the path of least resistance. Here's the psychological magic. You can't interrupt what you don't see. If the money hits your investment account before you see it in your checking account, you never experience the loss. You never feel the temptation to spend it. The friction, the mental friction, is removed. This is not willpower. It's not discipline. It's engineering your life so that the right choice is the lazy choice. The people who get wealthy are often not the smartest. They're the ones who found a way to stop fighting their own nature. They automated themselves into success. There's a study of financial outcomes across different demographics that shows something fascinating. People with access to automatic payroll deduction into retirement accounts, 401ks, pension plans, accumulate orders of magnitude more wealth than people with the same income who have to manually decide to invest. Same income, same time horizon, different automation. The gap is not small. It's often the difference between comfortable retirement and not. One group automated. One group had to remember. The human brain failed at the remembering part, which is what human brains do. This is not motivation. This is not mindset. This is the difference between a system that works and a system that requires you to be perfect. The greatest wealth builders aren't the hungriest. They're the laziest ones who found the right automation. Now here's where this gets complicated because nothing stays simple.
Compounding only works if the underlying investment actually grows, and markets don't just go up forever. They crash regularly, sometimes brutally. If you automated $200 a month in 2007, you watched your account shrink 50% in 2008. Most people panicked and stopped contributing. Some pulled their money out. The people who kept the automation running, they actually benefited. They were buying more shares at lower prices. They didn't feel like they were benefiting because the numbers looked smaller, but they were compounding harder on lower cost basis. This is abstract, and it's infuriating when you're watching your account drop, but it's the mechanism that makes compounding actually work. You need volatility. You need crashes, because crashes are where the magic happens. But understanding this intellectually and living through it are different things. This is also where risk gets real. Not all investments are created equal. A 7% average return on a diversified index fund has historical backing. It's boring because it's proven, but some people need faster. They need different, so they chase yield. High-yield savings accounts promising 15% returns, emerging markets, cryptocurrencies, peer-to-peer lending platforms, options trading. All of these have one thing in common: higher promised returns. They also all have higher risk, sometimes much higher risk. The guy you went to high school with who posts screenshots of his trading gains on Instagram is not a genius. He's a person who succeeded in an up market during a window where his specific strategy worked. He's also probably not showing you the accounts that blew up, the leverage that bankrupted him, or the months where nothing worked. You're seeing survivorship bias and selection bias distorted through social media. The uncomfortable part about compounding is that it rewards patience and simplicity. It punishes chasing returns. If you earn 7% boring consistency in 40 years, you've turned 100,000 into over 1.4 million. If you chase 20% returns and fail half the time, ending up at 8% average, worse than boring, you've turned 100,000 into 2.2 million. Sounds better. Except the person chasing 20% has probably lost money twice, had 3 sleepless years, switched strategies 4 times, and paid 40,000 in taxes and fees getting there. Compounding works best when you're boring enough to actually stick with it for 40 years. That's not inspirational. It's the opposite of inspirational. It's depressing. And yet, it's true.
But there's a bigger question beneath all of this that we should touch. This entire strategy assumes the system that created it will continue to exist. You're betting on the stock market existing, on companies continuing to produce value, on inflation staying at 3% and not 30%, on the currency you're accumulating not becoming toilet paper. These aren't crazy bets. They're the bets every economist and long-term investor is making, but they are bets. Throughout history, wealth stored in financial assets has been vaporized by inflation, war, political collapse, and currency crises. It happens. Not often, but regularly enough that it deserves to be in your mental model. This doesn't mean don't build wealth through compounding. It means don't build only that way. Real assets have a place. Skills have a place. A business or side income has a place. Some people keep gold or other real assets as a hedge. Some people emigrate to hedge political risk. The people who actually sleep at night while compounding works are the ones who understood the system deeply enough to know its fragility, but also the ones not paranoid enough to let that prevent them from using it. It's a balance. It's boring. It's also probably why some people get wealthy and stay wealthy while others accumulate and then lose it all when they panic. So here's what actually happens when you automate your wealth building. You set up an automatic transfer, you forget about it. You go to work, you live your life, you come home, you hug your kids, you eat dinner, you watch television, you sleep. Meanwhile, your money is compounding. Years pass, you get promotions, your salary goes up, you increase the automatic transfer by $100 a month. You forget about it again. More time passes, you experience market crashes, and you don't panic because the amount feels smaller now compared to the gains. You've zoomed out. One day, when you're much older, you notice that you're not thinking about money the same way. You're not anxious about retirement. You're not calculating how many more years you need to work. You're making choices about what you actually want to do, not what you have to do. That shift, that transition from constraint to option,
That's what compounding actually delivers. It's not exciting. It's not a story. It's just the boring mathematics of time plus growth plus patience. And maybe that's the real question worth asking yourself. Not, how do I get rich, but am I willing to be this boring for this long? Because the people who are, the ones who actually have the wealth, they'll tell you the same thing. It wasn't hard, it was just long. And somewhere in that patience is where it all actually happens.